Okay, if you're gearing up for the CMA exam, there are some topics you just have to know cold. And today, we're diving into one of the big ones, the pro-forma income statement. Now look, this isn't just about plugging in numbers, it's about getting to the heart of a company's game plan. So let's jump right in.
And honestly, this quote right here, it's the perfect way to think about it. See, a regular income statement, well, that's a history report. It tells you what already happened. But a pro forma, that's our financial crystal ball. We're taking smart, educated guesses to paint a picture of where the company's headed. So you see this Latin phrase as a matter of form, and it sounds super academic, right? But in business, and especially for your exam, it really just means one thing. We're forecasting. We're looking ahead. It's the difference between looking in the rearview mirror to see where you've been versus looking out the windshield to see where you're going.
So, how do we actually build one of these things? Well, it all boils down to one simple, non-negotiable rule. This is something you've just got to burn into your brain for the exam. I call it the golden rule of forecasting.
Yep, that's it. Everything. I can't stress this enough. You literally cannot build a pro forma income statement until you know how much you expect to sell. That sales forecast, that's your foundation. It's the starting line. Every single other number we're about to calculate flows from that one assumption. It's the first domino, and it's the most important one.
And this right here shows you exactly why that sales number is so important. Think about it. Most of your costs are tied directly to how much you sell. Your variable costs, like the cost of goods sold, they move right along with sales. And you're going to see this on the exam for sure. They love to test what's called the percent of sales method. It's a simple idea. It just assumes that if sales go up by 10%, then your COGS will go up by 10% too. It's a core assumption you've got to master.
All right, so let's get our hands dirty and look at the mechanics. Now, the good news here is that once you have that all-important sales forecast, you're basically just following a pattern that should feel very, very familiar.
So how does this all come together? How do we actually build the thing? Well, here's the blueprint.
Now, what's awesome here is that this is the same multi-step income statement you already know. We start at the top with our projected sales, we subtract COGS to get to gross profit, then we take out our operating expenses to find our operating income, and so on. The only real difference, every number you see here is a forecast, not a historical fact. So think of it like a familiar map, but we're using it to explore a future uncharted territory.
Okay, lean in for this one, because this is a classic exam trap. It is so easy to just look at last year's income statement and carry over the interest expense. But you can't do that. You have to ask yourself, does our growth plan require us to take on new debt? Because if it does, and it often does, your interest expense must go up. The exam is testing to see if you get that connection between your future plans and your future financing. It's a tricky one, so don't fall for it. Okay, so we know how to build it, but why bother? What's the point? And trust me, the CMA exam wants you to know the why just as much as the how. This is way more than just a school exercise for management. These forecasts have three massive strategic uses. First up, feasibility. I mean, is this new project, this new plan, even going to make us money? Second, we use it for sensitivity analysis. This is our what-if machine. What happens to our bottom line if sales come in 5% lower than we're hoping? And third, and this is a big one, securing outside funding. No bank is going to give you a loan without seeing a pro forma. They want to see your plan to pay them back. This is also where that concept of external funds needed, or EFN, comes into play, calculating how much cash you need to raise to make your growth happen.
All right, let's wrap this up. To bring it all home, I want to give you my final checklist. My 3 clarified tips to make sure you absolutely crush these questions on exam day.
Number 1, always check your units. When the sales forecast grows, you have to ask, is it because we're selling more stuff, or did we just jack up the price? The difference is huge. Number 2, don't you dare forget depreciation. Yeah, it's a non-cash expense, but it's tax deductible. That means it lowers your taxable income, which lowers your actual cash tax bill. And number 3, do a quick logic check. If you see a question where sales double, but the net income triples, that's a giant flashing sign. It's screaming at you to think about high fixed costs and the power of operating leverage. And in the end, that's really what this is all about. A pro forma income statement isn't just some boring spreadsheet. It's a narrative. It's a story about a company's ambitions, its strategy, and its potential, all told in the language of finance. Now that you have the tools, you'll be ready to analyze that story and even help write the next chapter.